I now want us to shift our focus. So far, we've discussed together the income statement and the balance sheet. Our final focus is on the statement of cash flows. Cash is a really, really important asset. You may have heard the phrase, cash is king. Truly, much of a company's success depends on their ability to efficiently manage and generate cash flows. In order to build a complete cash flow statement, we're going to need both the income statement and the balance sheet. And as I'll show you, it's possible to derive the cash flow statement using three things: this year's balance sheet, last year's balance sheet, and then this year's income statement. Although we could get away with just preparing a balance sheet and an income statement, preparing an additional cash flow statement, although not always required, does provide some very, very valuable information. Cash does appear on the balance sheet, as we know, and cash can be compared to prior years when performing an analysis. But we don't get much insight into how efficiently and effectively cash is being generated and used. Understanding where cash is coming from and how it's being used is very critical for both management and potential investors. There are many, many transactions that will have an impact on cash. Now, some of these will have a direct impact, and they're really easy to identify. We've seen some cash come in so far from, for example, the issuing of shares, the borrowing of debt, and revenue generation. We've seen cash go out as well from things like purchasing goods and services, purchasing assets like equipment, and, for example, making repayments on outstanding debt. One of the most important concepts that I want to take you through is to really explain the difference between profit and cash. Critically, profit and cash are not the same thing. At the beginning of the course, we learned about prepayments and accrued expenses. The accrual concept requires a business to recognize revenues and expenses on the income statement as it earns or incurs them, not when it either receives or pays cash, as we saw. Now, when we look at the cash flow statement, on the other hand, the cash flow statement looks only at when cash is paid or received. Let's explore why profit and cash are not the same thing with a tangible example. Let's imagine you were to buy a 5-day transit metro pass that cost $40, and you paid for it all with cash on Monday. Let's also assume that you use the travel pass every day from Monday to Friday. What would you say the daily cost of travel is? Let's say on Thursday. If we were to use a purely cash flow method approach, you would have to say that it costs $0 on Thursday because no cash was paid on Thursday. However, the matching accrual basis tells us that really the travel that we incurred should have cost us $8. We get 8 by taking the total cost of 40 and dividing it by 5 days. So which basis do you think better reflects the cost? Now, from a cash flow basis, it really is useful to know when the cash is paid so that we can plan for future cash inflows and outflows. However, a matching basis is better for planning the daily cost. Really, both approaches provide different but very valuable information. There are actually 2 different methods you can use to create a cash flow statement. Each method has benefits, but the direct method can actually be very tricky, and it also requires a lot more detail, which can make the whole process a lot more time-consuming. The indirect method talks about the impact on cash of management's decisions around operating, investing, and financing activities. I'll show you how both work and why most organizations prefer to use the indirect method. Let's explore together how the cash flow statement is different from the income statement. And we're also going to show you how you can actually calculate a cash flow statement using a direct method and an indirect method. Now, I need to really stress that everyone typically uses the indirect method. So after we go through this activity or exercise for a company I'm calling ShipShape Retail, we're only going to use the indirect method because it's very easy or much easier than doing the direct method. Now, let's explore 4 years of this business, and we're going to record the transactions to see how the income statement and cash flow are the same and also where they differ. So here we have a situation where in the first year, all the expenses and all the revenue are cash. We only have one non-cash expense, and that's depreciation. So we're going to record anything that's revenue or a cash inflow as a positive number, and anything that's an expense or a cash outflow as a negative number. Okay, so let's actually start with cash purchases. We bought cash purchases, which is an expense, as a negative number. That's a cash outflow, so that's a negative number. Our net income matches our change in cash. Now, our indirect method, what we do is we start always with net income, and then we make adjustments for what we call as non-cash items. And one of those is depreciation. So what I'm going to do is I'm just going to link net income in here. And you can see that after that first transaction, there's no difference right now between the income statement and the cash flow, and that's because all of our expenses are in cash. The only time they're going to diverge is where our expenses or our revenue are non-cash, or there are other non-cash expenses like depreciation. So let's do cash sales. Cash sales, revenue is a positive number of 370. It's a cash inflow, so we record that as a positive number. And you can see we don't have to do anything with the cash flow indirect, because now with the cash flow indirect, we're only going to add items that are non-cash, and we make those adjustments. So we will do one, but it will be related to depreciation. We have cash expenses of 40. So that's an expense, a negative number. That's a cash outflow, so that's going to be a negative number. And so far, everything's matching, and that means that everything on the income statement is cash. I know I'm stressing it, but the key thing to remember is why does the cash flow and the income statement, why do they diverge? It's because of non-cash items. Here we have number 4, which is depreciation, which is an accounting entry, not a cash entry. So it is an expense, but there's no cash flow related to it. So nothing changes here. Now what we want to do is we actually want to reflect adjustments that are non-cash, so we actually know what the change in cash was. And so what we're going to do is we're going to add back an expense that's non-cash. So now you can see that our cash flow direct and our cash flow indirect match. It's just two different ways to get to the same conclusion. Either start with net income and adjust for non-cash items, or just record the cash transactions, which we see with the cash flow direct. Now let's do it again with year 2. So now we have cash purchases of 280. So I'm going to go minus 280. That's an expense. There's minus 280. And I'm also going to make sure I link net income on the cash flow indirect to the bottom of the income statement. Everything matches. That's because everything's cash. We have cash sales, and our cash sales are 300. Our cash from sales is 300. Whoops. Put it the wrong sign. That's 300. And we're still all matching at the bottom. Now we have a non-cash item. We have sales on credit. So we have sales on credit of 170. So those are sales, but we haven't received the cash. So what we need to be mindful of is that those sales on credit is money owed from customers or accounts receivable. So because it's a non-cash item, in an indirect method, we have to adjust for that. And what we're adjusting for is any increase in accounts receivable is cash that really we should have had. So we're going to record it as a negative number because it's not cash. It's cash that's still sitting with the customer. So I'm going to record the minus 170. And you can see, therefore, our cash flow direct and our cash flow indirect now match. We have cash expenses of 50. Again, everything's matching because there's not a non-cash item there. Now, we do have receipts from receivables. So what we have here is our cash from sales has gone up by 140. So now we have 110. But what we had was we had an increase in accounts receivable of 170, but now 140 has come in. So we're going to have to take 140 off that balance because our receivables after both transactions have not increased by 170. They've only increased by 30. And you know we've got it right because the cash flow direct and cash flow indirect should always match. It's just two different routes to the same end. Now, we finally have depreciation. Again, we're going to have a difference now between the income statement and our cash flow. Our depreciation is going to be 55. There's nothing that hits a cash flow direct because it's not a cash flow, but we need to add back our depreciation of 55. We know we've done it right because our cash flow direct and cash flow indirect give us the same number. And now it's different than the income statement, reflecting that some things were received or not received in cash. Ready for year 3? Let's try year 3. Now, you may want to pause and actually try this first, and then I'll debrief it with you. It's your call, but let's get started. So now we have a number of transactions. We have cash purchases of 150. There's our cash purchases of 150. It's a cash outflow. I'm going to start by letting net income get linked on the cash flow indirect to net income on the income statement. Everything's matching. We then have cash sales of 320. That's 320 cash inflow. We have 170. Our cash flow direct and indirect still match. We then have sales on credit of 310. Now we have an increase in accounts receivable of 310. So I'm going to put here a cash outflow of 310 because it's cash we would otherwise had. But again, we may need get some money in from receivables. We may need to adjust that. And again, our cash flow direct and indirect are matching, which is great. We have purchases on credit, and those are of 180. Now, there's nothing that happens here because there's no cash related to those purchases. They're on credit, but we have a change in accounts payable. Now, we actually had purchase on credit of 180. Now, the neat thing about this from a cash flow perspective is we're actually going to add that back because it is, we should have paid that cash out, but by not paying that cash out, we're saving cash. So I'm going to put a positive 180. And we know we've done it right because, again, the 170 in the indirect cash flow matches the 170 on the direct cash flow. Now, we have receipts from receivables. So this is not hitting the income statement, but it is hitting the direct cash flow. We get receipts from receivables of 260. Let me just put an equal sign there. And what we have to do here is adjust our accounts receivable. So yes, they first increased, but then we actually got payments in. So we're going to then decrease that by 260 that we received because our increase in receivables was only actually 50. We know we've done it right because those changes in cash match. We also have payments to payables. So what we're saying here is we actually had more cash outflows of 140. Doesn't impact the income statement, but we also see that we said that we had increases in AP of 180 that was saving us cash. However, we did pay some of that cash out. So now we're going to be sitting at 40. Again, the good news is always check, do these balance? Because a direct and indirect cash flow should always come to the same number. Now, we have a couple more things. We have a cash expense of 70. That is a cash expense. So that's matching there. Good. We're still balancing. And then we have depreciation of 55. We know that's an expense, but we also know it's a non-cash expense, so we have to add depreciation back. And congratulations, the direct and indirect cash flows match. We've recorded the transactions. Let's try one more year. I encourage you to first have a go, push pause, and then when you're ready, I'll debrief it with you. Okay, so let's do year 4. And you're going to see I've added a separate column here, and it's because we have to be careful of our opening and closing balances of inventory. So we've done changes in accounts receivable. We've done changes in accounts payable. Now we need to think about changes in inventory. So let's start with cash purchases. And our cash purchases, we're assuming, by the way, there's no opening inventory. So I'm just going to capture that. And our cash purchases are 200. And our cash purchases are 200. That's a cash outflow. And I'm going to link net income on the indirect cash flow. Now, one of the things I'm going to capture here is that I'm going to sum these together. And I'll explain why I'm doing this, but I just want to make sure that our indirect cash flow and our direct cash flow, those numbers are matching, because that's a good check that we've recorded things correctly. So what we're going to do is we then have cash sales. That's cash sales or revenue of 400. We also have cash sales of 400. Good. Everything's still balancing. We have sales on credit of 410. So let me put an equal sign there. That's not going to hit the cash flow direct because they're on credit, but we have an increase in accounts receivable. And that has to be recorded as a negative number because it's cash that we would have otherwise receive that's still sitting with customers. Okay, so now let's go to the next one. We have purchases on credit. So we're going to add more purchases there of 380, but that doesn't impact the direct cash flow, but we do have to make an adjustment for accounts payable on the indirect cash flow. This is going to be a positive number because we haven't had to pay the cash yet. We haven't had to have a cash outflow. So we're going to put plus 380. And we know we've done it right because, again, the direct and indirect cash flow, those balances at the bottom match. Now, we have receipts from receivables. This doesn't affect the income statement, but it is going to affect the cash flow direct method. We got receipts from receivables of 390. And it means that our balance on accounts receivable, although it did go up to 410, it then was reduced by 390 so that it sits right now at negative 20. Again, the direct and indirect method match, always a good check. Next, we have payments to payables. Now, our payments to payables means it's going to affect our direct cash flow, and that's 360, cash going out, so it's a negative number. And it means that our accounts payable increase is actually reduced because we did pay 360 of it. So I'm just going to put an equal sign there and then minus 360. Great. Our change in cash is the same under both methods. We then have cash expenses of 100. Everything looks good there. We have depreciation as before. We have to actually add that back on the indirect. So far, so good. There's only one new element in year 4, and that's the inventory. In the previous years, what we saw was that inventory was at 0 at the end of the year, but now we have some inventory that is left. And so we need to reduce our cost of goods sold. And we're going to capture that closing inventory in row 89. And so the inventory at close was 35, and that's going to be a positive number because what I want is how much of the purchase expense relates to this period, and only 545 does. Now, what we also need to do, and you're going to see this here, is they don't match, and it's because we also need to think about the non-cash expense or non-cash impact of this inventory. And what's happened to inventory? It's gone up. And so very much like receivables, that's eating cash that we would otherwise have. So it's always going to be a negative number. And so it's going to be minus 35. And we know we've done it right because our direct and indirect cash flows, the change in cash matches. For the rest of this course, we're going to focus on the indirect method, which, as I've already mentioned, is by far the most common approach used by organizations. There are 3 main sections on the cash flow statement. The first section focuses on a business's operating cash flows. Operating cash flows and transactions are those that relate directly to the generation of revenue, whether that be revenue or expenses. And basically, they're the reason the company is in business. Investing transactions and cash flows include decisions around things like the purchase of property, plant, and equipment to really support the business and its operations. So, for example, manufacturing companies will need to buy factories and equipment to manufacture inventory for sale. Services businesses may need to buy buildings and furniture to support their operations. Finally, we have financing transactions, which are based on management's decisions around how best to fund its business activities. A business typically has two standard sources of funding: raising equity from shareholders by issuing shares, or raising debt finance by borrowing from financial institutions like banks and credit unions. These cash flows are all captured in this section of the cash flow statement. Now let's work through each of the three sections in a lot more detail. We'll start with cash from operations. Recall that the operating cash flow section starts with net income, and then what we do is we make adjustments for non-cash items like depreciation and changes in working capital. Remember changes like accounts receivable, inventory, and accounts payable. One of the trickiest parts from my experience as it relates to the operating section of the cash flow statement is really understanding how changes in working capital, that's things like accounts receivable, inventory, accounts payable, and unearned revenue, impact cash flow. So for this reason, I want to walk you through this in some detail. Now, when we're dealing with transactions that have an indirect impact, we need to look at what has changed, and then what we have to do is determine if that indicates an increase in cash flows or a decrease in cash flows. Let's look at accounts receivable, inventories, accounts payable, and unearned revenue individually. So we're going to start with accounts receivable. In year one, this company had $46,000 in accounts receivable. In year two, the accounts receivable increased to $51,000. As the result, the company has $5,000 less cash. In contrast, if we saw accounts receivable go down, the business would have received more cash. So, in summary, when you see accounts receivable goes up, cash is going down, and we're going to express that as a negative number. Conversely, when accounts receivable goes down, cash is going up, and so we're going to express that as a positive number. For inventory, we're really looking at how much have we sold. When we sell inventory, we obviously bring in cash. Now, if our inventory goes up, we consider a business to have received less cash because inventory is piling up. In this case, inventory decreased from $82,250 to $78,050, which indicates a net increase in cash of $4,200. Now, inventory is very similar to accounts receivable. They're both current assets. So when inventory goes up, cash is going down. So we're going to express that as a negative number. And when inventory goes down, cash goes up. And we represent that with a positive number. We're now going to move from assets to liabilities. Now, liabilities work in the exact opposite way to what we saw with assets. So for example, if accounts payable goes up, the company has used less cash to make their vendor or supplier payments. On the one hand, it's good that the company is paying down its liabilities. However, this results in less cash on hand. So just remember that liabilities work the opposite way to assets. So when accounts payable goes up, cash goes up, and we're going to show that as a positive number. But when accounts payable goes down, cash goes down, and that's represented with a negative number. With unearned revenue, it's going to work very similarly to accounts payable. Remember that unearned revenue, sometimes called deferred revenue, is recorded when a company receives cash in advance of providing the service or selling the good. As a liability, it works the same as we saw for accounts payable. So if unearned revenue decreases, as is the case here, it indicates less cash received in advance and is therefore shown as a net cash decrease of $2,900. So in summary, when unearned revenue goes up, cash goes up, and we show that with a positive number. Positive numbers are used for cash inflows. When unearned revenue goes down, cash goes down, and we show that as a negative number representing a cash outflow. Let's build out an indirect cash flow statement, starting by focusing on operating cash flows. Now, what we're using is the Cobble Hill year 1 and year 2 exercise we did earlier, and we're just building on that. But right now, we're just going to focus on the first section, and I'll just zoom in a bit. And that's our operating cash flow. So we're going to start with net income. We're going to add back depreciation, which we're going to find on the income statement. Then we're going to have to look at changes in accounts receivable, inventory, and accounts payable to get us a cash from operations. Okay, so let's get going. So the cash flow is at the top. I'm going to start linking this, and I'm going to go down now. I need to go to the income statement right at the bottom. I need to go to net income. We're going to start with 8. Then what we're going to do is we're going to add back depreciation. So I'm going to put a negative sign here, because then what I'm going to do is I'm going to find that depreciation number, which we know is 90. And I need to make sure it's a positive, because remember, we add back non-cash expenses, and that's depreciation. Now we have to think about what's happening with accounts receivable, inventory, and accounts payable. First of all, remember that inventory and accounts receivable are both assets. So we're going to treat them in a very similar way. Accounts payable, we're going to treat in the reverse way. So let's go to the balance sheet and just look at the differences between accounts receivable, inventory, and payables between years 1 and 2. Now, what we have in year 1 is there was 80 of accounts receivable, but that 80 has now increased to 150. So that's more cash tied up with customers. So you want to think of that as a cash outflow. Here we have inventory of 60. Inventory's increased to 80. So we have more cash tied up in inventory. So that's also going to be a negative number. The way I like to do it is just make sure that I am taking always the previous year and I subtract the current year for assets to make sure the sign is the right way around. I'm just going to copy that down. So we know it's minus 70 for accounts receivable and minus 20 for our inventory. So I'm going to just now capture that. Minus 70 and minus 20. Good. I'm just checking that I got the right numbers there. Now we need to go to accounts payable. Now, when we look at our accounts payable, you're going to see that it's increased. Now, the good news here from a cash perspective is that that's cash that we owe that we still haven't paid. So that's cash that is still with us. So the way we make sure we have the right sign is always take the current year minus the previous year. It needs to be a positive number if accounts payable has gone up. So we know that's a positive 20. I'm going to capture positive 20. And then I'm just using alt equals to sum that up. And congratulations, we've done the first section of an indirect cash flow statement focusing on operating cash flows. We are now going to turn to the second section of a cash flow statement, and that's cash from investing. The good news is cash from investing generally is a bit easier to understand. In this case, the company purchased $45,000 of equipment in their first year of operations. As a result, cash decreased by $45,500 in that year. In the next year, they invested an additional $50,000 of equipment to expand their operations. And if we look at the fourth year, they invested another $59,500. In each of these cases, this investment is considered a cash outflow and is represented by a negative number. These investments are often referred to as capital expenditure, or CapEx for short. Before moving on to the next section of the cash flow, it's interesting to see how the financial story of non-current assets are reflected on each of the statements. In particular, how investing activities like CapEx ultimately hit all three financial statements. We just saw transactions related to the purchase of property, plant, and equipment, or CapEx. But recall that once we have those assets, they're put on the balance sheet, and then we depreciate those assets over their useful lives. So we have a cash flow impact from buying the property, plant, and equipment a balance sheet impact in terms of property, plant, and equipment as a non-current asset. And on the income statement, we're going to see an expense related to depreciation. Let's look at a tangible example of how this works in practice. Let's imagine that a company has an equipment purchase in year one for, let's say, a company car, and they're going to use straight line depreciation. So first of all, we need to calculate the depreciation expense. We know the car was purchased for $45,500. We're going to assume a useful life of 10 years, and we're going to say at the end of 10 years that the car will have no salvage value. So using our straight line depreciation approach, we can calculate that the depreciation on this asset, the car, will be $4,550 a year. Let's see how all of this impacts each of the financial statements. On the income statement, the depreciation expense is either going to be shown separately as a separate line item called depreciation expense or depreciation and amortization expense. Sometimes, though, that depreciation expense is combined with other operating expenses. So we might find that depreciation in direct or indirect operating expenses. So that's the income statement. Now let's look at what's happening on the balance sheet. On the balance sheet, we're going to first see the purchase or the CapEx first recorded as the cost of the asset under property, plant, and equipment, or PP&E. That will be $45,500, but we will also record accumulated depreciation as a contra asset account also on the balance sheet. So the equipment then has a net book value at the end of year one of $40,950, taking off 1 year's depreciation. Finally, let's look at how CapEx hits the cash flow. We've seen that CapEx hits the cash flow directly under investing activities, but it also impacts the cash flow statement indirectly through the operating cash flow section. Recall that we need to add back non-cash expenses, and one of the largest or most common is depreciation. So under the operating cash flow section, we're going to add back depreciation related to the investment in CapEx, but we're also in the investing section going to show the cash outflow when we purchase the asset. Now let's focus on the investing cash flow activities. Typically, the primary cash flow activity here is buying property, plant, and equipment. So now let's work through it. Now, what we have is we just have that one line item, but we often need to try to back out what the capital expenditure actually was. And I can show you how to do that. So if we scroll down and we find row number 34 through 37, what we have here is I've started filling it in. I'm just going to delete that. And what we're going to do is we're going to back out CapEx. And what I mean by that is we can solve for CapEx or capital expenditure because we'll know what the opening balance is, the closing balance, and we know what depreciation is. And the number that makes it all balance has to be CapEx. So what I'm going to do is the opening balance for year two is the closing balance for year one. We also know that the PP&E at the end of the year is going to be on the balance sheet. It's $720. We also know that the depreciation expense is $90, but I'm just going to link it to the income statement. And now all we need to do is we can solve for CapEx because that's going to be the difference. And the way we do that, I'm just going to go equals, it's the closing balance minus the depreciation, or add back the depreciation, minus the opening balance. And so what this tells us is there was no new spend on property, plant, and equipment in the year. But I always like to check to make sure it's working. So I'm going to kind of destroy the balance sheet just for a second, and then we'll restore it. What I want to do is I'll say, okay, well, that's because there's 810, there's 720. We know that depreciation was 90, which is why we know CapEx. There was no CapEx. Now, if we said that that property, plant, and equipment at the end of the year was 800, now remember the balance sheet's not going to balance because I've just overtyped it. What that means is we have to think about what would that mean for CapEx. And if we go to our formula, you can see now a number in CapEx. What we're saying is that there had to be 80 spent on new property, plant, and equipment for this equation to hold. So let me just do Control Z or Control Z to undo that. Because congratulations, now all we need to do is we need to link that number into our CapEx, but one of the things I'm going to flag is it's a cash outflow. And so we need to make sure it's always the right way around. So I'm going to put a negative sign there. And again, I'm going to show you why we need to do that. Let me overtype the 720 again with 800. So we know our CapEx is 80, but it's a cash outflow. So we need to make sure there's a negative sign there. So let me type that back to 720. And we are good. And then the total, there's only one item here. We are done the investing cash flow section of our indirect cash flow. The final section of the cash flow statement deals with the changes related to how management finances the business. This includes typically two main areas of finance: debt finance and equity finance. Let's start with debt finance. On the debt side, cash is going to increase whenever a company borrows money, and cash is going to decrease as that loan or debt is repaid. Now, remember that payments associated with debt can be both principal payments, but they can also be interest payments or a combination of both. In this case, we can see borrowing in year one brought in $50,000 of cash. So it's a cash increase or a cash inflow, which is why it's shown as a positive number. However, when we look at year two, the company actually paid off the loan, leading to a cash decrease of $50,000 or a cash outflow, which is why it's represented by a negative number. Let's now turn to equity finance. Cash is going to increase when a company issues shares for cash. And cash is going to decrease if it repurchases those shares or if the company pays out dividends. When a company issues shares for cash, this will be shown as a cash inflow, which is a positive number, while if the company repurchases shares or pays out dividends, these are both cash outflows and they're going to be shown as negative numbers. Here we see no issuance or repurchase of shares in either year one or year two, but the business has paid a dividend both years, which is why you see these both as negative cash outflows. Let's look at the third and final section of the cash flow statement, and that's cash flow from financing activities. When we talk about financing, we're talking about really how is the organization or business funded. A business might be funded through equity or through loans from the bank, like debt finance. And we need to think about the direction of the cash flow. So if an organization or business borrows money from a bank, that's a cash inflow. When it repays the loan, that's a cash outflow. When a company issues new shares, that's a cash inflow, but a company may buy back shares from its shareholders, and that would be a cash outflow. Part of financing as it relates to equity also involves paying dividends. So we'll capture dividend payments also under financing activities. So let's actually build this out, and then we will complete the cash flow statement. So what we have is we need to look at what's happened with debt. A repayment of debt is going to be a negative number or cash outflow, recall. So when we go down to our long-term debt, you may recall when we did the activity, we repaid 100 of the loan in year two. So that's going to be a cash outflow of 100. Now let's look if anything happened to equity. So I'm going to go back to the balance sheet. I'm going to look at row 70. And you can see that our common shares haven't changed. So we neither issued new shares or bought back shares. So there, we're going to just be able to type in a 0. But you may recall we did pay a dividend of 5, and that's a cash outflow. I'm just going to link that. I'm going to go to the bottom of the income statement. There's the dividend in row 103. I'm going to hit enter. So we have 3 cash flows. Although in this case, there were only 2, they were both outflows. So I'm going to just sum that up. So we have a positive cash flow from operations of 28, no cash flows in or out related to investing activities this year. And then we have a cash outflow as it relates to financing activities. Let's sum those 3 together. So that's the 28 plus the cash flow from investing of 0 plus the cash from financing of negative 105. We then need to just put in our opening balance, and that means our closing balance is 419. In other words, what we're saying is we started the year with 496, but there was a net cash outflow of 77, which means our cash balance at the end of the year was 419. Let's do one final check because always the cash flow balance at the end of the year needs to match what we have on the balance sheet. Let's make sure we have 419 there. And if we go to row number 47, yep, we've got it. We did our cash flow correctly because it matches the cash flow, or the cash, I should say, on the balance sheet. Now what we're going to do is we're going to calculate a cash flow statement again. I'm going to show you a slightly different format that you may find easier to understand or easier to complete. Now, I've called this activity or this company Ravensburger Inc., but if you look closely at the numbers, they're actually the same as Cobble Hill. I've just laid out the income statement, balance sheet, and cash flow in a different order, which is going to allow us to build that cash flow and always have sight of the income statement and balance sheet. Now, the instructions also are at the top. So I'm going to encourage you to go work through this with me, following those instructions. Feel free to speed me up or slow me down. And then there's another activity that's similar called Springbok that I want you to have a go on your own, and then I'll debrief with you. So let's actually, the first thing, it says calculate the differences on the balance sheet. What I often like to do is actually have a column where I'm just calculating the differences. So all I'm going to do is actually take the current year and I'm going to subtract the previous year. And I'm going to go Control C and Pay Special and just the formula. And then I'm just going to hit F4 and I'm just going down all the items. This is just going to save me a bit of time as I go to the cash flow statement. So now what I'm going to do is I'm going to start with net income. And I'm going to link that to row 29. That's E29. You know we add back depreciation, and that's going to be E22. Now the change in accounts receivable, remember we have an increase of 70 for accounts receivable and an increase of inventory. And when those assets increase, it means less cash. So we have to make sure those are cash outflows. So now I'm just going to put a minus sign, minus 70, and I'm going to copy that down, Control D. With accounts payable, we know that accounts payable has increased by 20. That means we've kept cash that we would otherwise have to pay to suppliers. So that's a positive number. So I'm going to go plus and select the 20 there. I'm going to sum it up, and we have our cash from operations. Now, recall that we need to calculate the property, plant, and equipment. And recall that we did this together. I'm just going to zoom in just so you can see it more. Remember the formula was actual equals PPE at the end of the year minus depreciation, which is adding it back because we're minusing a minus the opening balance. And we know that, whoops, apologies there. Let me just get a bracket. We know that's 0, but we're going to link that into here. And we're going to make sure there's a negative sign there, recall, because it's a cash outflow. And I'll sum that up. Now what we can do is we can look at issuing of long-term debt or repayment. You can see our long-term debt is down by 100. So I'm just going to, I can just link that right in because it's cash outflow. I can see there is no change in equity. And I can see that there's a dividend. I'm going to go over to the income statement. Remember, there was that dividend of 5. I sum that up. We know what our net increase or decrease is by just adding up cash from operations plus cash from investing plus cash from financing. We know our opening balance of cash was 496. And we know, hopefully, that we get our closing balance of 419. I've put a little check here because, again, the neat thing about doing your financial statements this way is that you know you've got your cash flow right when at the very bottom, your closing cash balance matches the cash that you have on the balance sheet. So now I want you to have a go. There's a very similar exercise with new numbers where you do the same thing and see how quickly you can build a cash flow. And then I will debrief it with you. Okay, see you in a moment. Let's practice one more time. Now, hopefully you've already had a go and you can check your numbers with mine or follow along with me. So let's get going. Again, the instructions are at the top. I typically like to calculate the differences first. And I'm just going to go year 2 minus year 1. I'm going to go Control C and paste special. Here's the formulas. And then I'm hitting F4 to repeat. And I'm just going to quickly go down all the line items on, or the accounts on the balance sheet. That just is going to save me some time. I still have to make sure I get some of my signs, the negative and positive, the cash inflow and outflow the right way. But now let's build that net income, or sorry, cash flow statement starting with net income. Now, net income is on, obviously, the income statement. We know that net income is 2584. We know we're going to add back depreciation, and that depreciation is 319. Now, I've already made a mistake because I need to make sure that's a positive because I'm adding it back. So I'm putting a negative sign there. Now we have a couple of other things. We have something called unpaid taxes. And what happens here is our unpaid taxes have gone down, which means that's been a cash outflow. So I'm going to capture that as a negative 43. Right? We have, because it's gone down, we know that we paid more taxes. Our change in accounts receivable has gone up. So that's more money tied up with customers. So recall, we're going to change the sign there. That's going to be negative 540. And our inventory has gone up by 193. So that's also cash that's tied up in inventory. So that's a negative number. And our accounts payable has gone up. And we know that's a positive number because that's money that we otherwise would have paid to our suppliers. I'm going to sum that up. And we get 5394. Now we're going to do the same thing with our PP&E. I'm going to zoom in here so we can see the balance. And what we're going to do is we know that the PP&E at the end of the year was 26193. We know the depreciation. We know the PPE at the start of the year. And so we're going to use the same formula equals end of year minus depreciation, really add back depreciation, minus the opening balance. Here we do have capital expenditure of 3420, but recall that's a cash outflow. So when we put it in the cash flow above, we're going to put a negative sign. And now I'll zoom out again just so we see a bit more. Great. And I know there's only one item, but I'll sum that up. Now what we need to do is see what's happening with our debt and our equity and dividends. Those are financing activities. So our short-term loans have been repaid. They've dropped, so that's a cash outflow of 339. A long-term debt has also been repaid, so that's a cash outflow of 812. Let's look at our equity. Our equity, as before, let me just scroll down here, hasn't changed. So I'm just going to link that to here. And we have paid a dividend. Let's just check what that dividend is of 1397. That's a cash outflow, so that stays as a negative. We can sum up the financing cash flows. Now let me just zoom out a bit more. I'm going to make sure we can see this in a bit more detail. Okay, now what we want to make sure is, of course, now when we sum this up, it matches the cash on the balance sheet. So we are going to, first of all, take our cash from operations together with our cash from investing, together with our cash from financing. Our opening cash balance is 3746. That's J15. And I add that up, and I'm hoping to get 3172. I did, and I have a check message there that's confirming that I've done my cash flow correctly because it matches the cash on the balance sheet.